Hi traders, you are welcome back to the Forex Geek channel, and I especially welcome you to this video where we're going to be breaking down the counter trend trading strategy. Okay, in this particular session, we'll go through what counter trend trading means, why it works under certain conditions, and how to use it effectively without exposing yourself to unnecessary risk. All right. First of all, it is important that we define what counter trend trading is, right? Counter trend trading simply means taking trades that go against the dominant direction of the market. For example, at this point, we had an obvious bearish trend. Am I right or wrong? Well, let me know in the comment section if you wish. So we are, obviously in a bearish trend. We were obviously in a bearish trend. Lower highs, lower lows, price was respecting the trend line. And, yeah. So counter trend trading means you are picking buy trades in a sell trend. It's as simple as that. So you are looking for buy opportunities in a bearish trend, or you are looking for sell opportunities in a bullish trend. Now, might actually sound a little bit crazy, but well, things happen, right? So now, probably you're trying to trade the pullbacks, you're trying to trade the retracement for reasons best known to you, right? Now, if the market is trending strongly upward, a counter trend trader looks for opportunities to go short. If the market is trending downward, they look for opportunities to go long. But here is the key, right? Counter trend trading is not about blindly fighting momentum. It's about identifying when the trend has reached a point of exhaustion, okay? And it is preparing to reverse or pull back. So now the first step is recognizing areas of exhaustion. That is the first step. Okay, trends do not last forever, right? As the market extends in one direction, it often sweeps liquidity from resting stops, at key highs or lows. For example, in an uptrend, price might take out the previous high, but then fail to continue strongly upward. That failure often signals that buyers are exhausted and sellers may soon step in. Okay. Next, you want to confirm with structural shifts. This means looking for breaks of structure on lower time frames. All right. You can just jump to a lower time frame to find a break of structure. Okay. If an uptrend suddenly breaks a higher low, for example, let's just find a good example now. So we are in an uptrend here, right? An uptrend. And then suddenly we can see that this higher low was broken. Boom. Right? And then it fails to recover. That's a strong sign that the trend could be weakening. So when combined with a liquidity sweep at the top, it creates a high probability counter trend setup. Okay? Another important element is market psychology. Strong trends build confidence in traders following the direction. But that same confidence can lead to overextension. Now, once liquidity has been taken and no fresh momentum appears, the market often punishes late entries by moving the other way. So as a counter trend trader, you are essentially capitalizing on that transition. Okay, now managing these trades is just as important as identifying them. Counter trend setups carry more risk because you are trading against the overall flow. This means your stops must be clearly defined. All right, and your entries must come from precise levels. Never jump in early. Okay, don't jump in too early. If you're a counter trend trader, make sure you get your confirmations before popping that buy or sell button, because you are playing against the prevailing momentum, so you have to be super careful, right? Your exit strategy also matters. Since counter trend trades are often shorter in nature, it's wise to target logical intraday setups like fair value gaps, imbalance fills, or previous structure points that rather than expecting a complete reversal of the market. Okay, remember, the goal is not to call the top or bottom of every move, but to capture the part of the market where momentum temporarily shifts. All right, so by practicing this approach, you will start to see the market differently. Instead of chasing trends at their peak, you will understand when the market is vulnerable to a reversal and be prepared to take advantage of those opportunities. Okay, now let's just go back to a higher time frame. Okay, so this was a bearish trend. Okay, so now I wanted to use an example that had significant pullbacks. So you can see that is a bullish trend, right? High, low. Well, we had equal lows here. Had equal lows around this zone. Higher low, higher high and higher low, right? Higher high and higher low, higher high and higher low. Now, as a counter trend trader, you can also be looking out for reversal candlestick patterns within the trend. You can look at what happened here now. You can see this bearish candlestick pattern we had here. So in as much as this is a bullish trend, but this pattern shows that there's a temporary change in momentum, right? So you can just quickly scalp the move from here to here. You can go to a lower time frame. You can be looking out for a change in character again, change of character, until probably you get a bullish confirmation, and then you quickly exit that sell trade. So basically it's a short-term trade, right? There are short-term trades when you're trading against the trend. Okay, then you can watch out again for any other bearish pattern. If you find another bearish pattern, you can then quickly grab that opportunity. Then you quickly jump out anytime you find a possible bullish pattern, even on the lower time frame, and so on and so forth. Okay, so but make sure you always get your confirmations before jumping into the trade, and always use tight risk just in case. All right, tight stop losses is what I mean. Always use tight stop losses just in case, okay, because you are trading against the prevailing trend. So if you found this video helpful, don't forget to click the like button and subscribe to the channel for more trading strategies and insights. All right, comment below and let me know if you like me to cover other strategies related to market reversals. In the meantime, thank you for watching, and I look forward to seeing you in the next video. Happy trading.